see they're starting to. To hand over an assignment today, so are you going to use that one?
All right.
I can get you another one.
Oh, I thought this. Is there a mark there?
Yeah.
I just was that.
Oh, I just walked too much, so I knew what it is.
I'm only going to be 3 minutes.
Yeah. Same here. So there's recording here?
Yeah.
All right. From camera somewhere? Or?
Oh, no, the camera's on. No, I think it only takes what it is on the screen
Ah, okay.
and the audio.
Okay.
We even have students participating live, so if they cannot attend, they can watch this live. So we do
So
questions.
they have remote access, they can ask questions?
No.
Okay.
But we have like a Q&A, a quiz during the class, and sometimes I'm counting the number of people here, and we see more people participating than people either from work or home
Okay.
answering the questions.
All right, that's cool.
See, these are if you start on the dot, then you have 20, 30 people coming in.
Yeah, that's right. Yeah.
No idea.
Yeah.
So if you're ready, I'm going to go up there.
Okay. So you let me know when I start?
Yeah, I will introduce you on my way back. From,
Okay.
Yeah. Good morning, everyone. Important day today. You're handing over your assignments. So we're going to start our lecture in a few minutes. Before we do that, we have two guest speakers for today. So we have Xiangxin Wang and Warren Hogan. They will be introducing you to the honors program. So please feel free to ask as many questions as you may have while they're introducing you to the program, or afterwards they're going to leave you with their contact details. So first of all, it's going to be Xiangxin Wang introducing you to the honors program.
Hi, everyone. Thank you. My name is Xiangxin, and I'm the honors director for the finance program. And my understanding that this class is students here are the third-year students, and you are very close to the job market. You probably are looking at various graduate programs from major financial institutions now. So I think this is a good time to introduce the honors program and show you there is an alternative plan for next year. So the honors program in finance, we've made some changes in the last year, 2018. Prior to that, the honors program was more focused on training for PhD programs. So it's really a lot of financial model, financial mathematics, especially for UTS. UTS has specialized in quant finance. So the new program is more geared towards a industry career. So we're making it very explicit. If you look across the honors programs in UTS, UCID, and UNSW, and the honors program in UCID and UNSW are still very much geared towards training for PhD. And we're making it more explicit because the fact all the other universities, including UTS, is that most of the honors, after graduating, they go to industry. 9 out of 10. So that's the demand from the students. We're catering to that. And the other reason is that there is a separate, 10 years ago, there's no PhD training in Australia in finance. Now there is a separate PhD training program in Australia. So we don't have to cater for that demand. Someone else cater for that demand. All right? And the new philosophy of the honors program is market-oriented with academic rigor. There's still academic rigor, but the issue you learn, the technique you learn, has to have real-world implication. It doesn't have to be investment implication. It can be trading strategy, portfolio management, risk management, or it can be policy implication, or it can be regulatory implication. So it has to be a real-world related issue covered in the subject and covered in the thesis. And the approach is more on the economic intuition, more on the hands-on ability, less on the model, mathematic rigor. So it's not a math finance program. It is a industry-oriented hands-on, but we do emphasize you want to build the economic intuition. You understand the economics, and then that's where you go down the line, that exercise that economic intuition and make a judgment. And the feature of the program is that instead of a generic finance program that covers the main field, we're having a specialization in funds management. We recognize that Sydney is a major hub for asset management in Australia, in Asia. And there's a huge demand for people with asset management knowledge. So that's where catering. And the other feature of the finance honors is that there's substantial engagement with industries. And we'll tell you a bit in detail. So in terms of honors training, we have financial econometrics, asset pricing, funds management, and advanced topics. And on top of that, before you start any subject, there is a boot camp, we call our training camp. For 2 weeks, for this year's batch of honors, we started at the end of February and first week of March, before the semester started. And 2 weeks is 3 or 4 different programming language, and probably 6 or 7 different financial databases. And then you have exposure to different fields of finance. People come in to tell you what are the latest research topics in behavioral finance, what's sort of the topics in the funds management and corporate finance and corporate social responsibility all different research fields you have a exposure to. So that's the subjects. That's in the autumn semester. And then the spring semester, you write a thesis. And thesis topics, like I said, should have practical implication. And you can have one-on-one supervision with a supervisor, or you can have cluster-based supervision. Let's say there's this field called market microstructure. Market microstructure look at high-frequency trading on a second-by-second base. And that's a growing research field, and UTS is quite strong. You may have 2 or 3 supervisors as a cluster and help you with your thesis. And last but not least, opportunity to work with the industry mentor. So after the subjects, mid-year, in mid-June or July, you need to write a thesis proposal, and then you have a chance to pitch that thesis proposal to industry partners. UTS has roughly 30-some industry. The finance group has roughly 30-some industry partners. And if you pitch it right and there's a good match, someone from the industry will become the mentor for your thesis. So you have an academic supervisor, and then you have an industry mentor. So this is sort of the industry participation in the honors program. We have monthly, at this stage, monthly industry seminars where the industry speaker comes in. The first Friday of every month, have lunch with honor students, and then maybe during the lunch is a Q&A session on some topic, and often it's after lunch they give a little presentation, talk about job specifics or the latest market development. The March one, we actually had 2. One guy from Bank of Merrill Lynch, and he's a bond trader. He's an ex-honor student, and he talked about bond trading in great detail. And the second speaker was another ex-honor student, alumni, and he talked about, he's at Goldman Sachs. It's called the Special Purpose Unit. It's somewhat like a hedge fund, and they do high-risk lending. And he talked at length about how that sector operates. And this batch of honor students are really smart. They have a lot of confidence given their performance, but then they look at these guys, they say, okay, I'm good, but these guys are here that I have to catch up to. Right? So we have this on a monthly basis. We're trying to get more than 1 each month, 2 or 3 or 4. So we're trying to build your industry exposure, knowing what's this job involved, what that job involves, so you can target your career, and also industry networking. Right? So again, we emphasize the aim of the program is add value to your long-term career. And we do this through the following. Advanced knowledge, that you go beyond your standard textbook, Bodie-Can-Marcus, your investment subject, standard textbook, and standard corporate finance textbook. You go a little bit above and beyond. In terms of the sophistication, in terms of economic intuition, in terms of technical aspect, hands-on aspect, you go a step beyond. And then a major part of the honors training is to stretch your intellectual ability, stretch your analytical ability, meaning that in those subjects, you need to write stuff, reflect your judgment. So that you're asked to write critiques, you're asked to write proposals. So that's the effort to develop your judgment of critical thinking. And like I said, industry exposure network and potential support on job market. Last but not least, again, eligible for advanced degree. If you stop here, You graduate, you have a 3-year bachelor degree. In the longer term, when you think about advanced degree, an MBA or a CFA, this will help you. The honors degree will make you eligible for top-tier MBA program in US. If you want to get an MBA at Stanford or Chicago, UCLA, you need to have a 4-year undergraduate degree. In the US, a 3-year bachelor degree is regarded as community college. And the honors program that gives you the extra year allows you to later on, longer term career development, have the choice to do an advanced degree. All right. So there will be, this document will be posted on your website, subject website. I'll pass it to Leo. And you can get some more details. There's an honors website. If you Google UTS Finance Honors. And the next, I'm going to invite Professor Warren Hogan. And Warren has a wealth of industry experience, and he will say something about the benefit of the long-term career development.
Okay. Thank you, and that was a great overview of what looks like a very exciting course. When I did honours, the level of theoretical detail and technical expertise amped up by about 100%. So this is going the other way. This is, of course, continuing to challenge you intellectually and raising the standards, but it is actually a step towards industry practice and highly relevant skills and connections and engagement with the private sector. So it's a really exciting course that's on offer here. So I would say, as someone who spent 20 years in financial markets and banking, hiring graduates, that the question for you right now needs to be why you wouldn't do that, not why you would. The 1 year of extra study on a 3-year degree might seem like a lot to you now, but it's nothing in the scheme of your career. And it adds more than, what, a third or 25% in terms of the extra time spent. It adds much more than that in terms of your expertise and your marketability. So just my background, as I said, in banking finance, I worked at ANZ for 10 years in their dealing room, running all their research, including strategy, as I was chief economist at the end there. I was at Credit Suisse before that as a bond strategist, which is mainly, it's fixed income, currencies and debt securities and so forth. So really right in the markets.
I think I want to bring back this page.
Okay. And so I've hired a lot of students, or had people in my team hire a lot of students, and the first thing you look at is their level of academic attainment, and not having an honours degree is a real blocker. I mean, especially in competitive markets. So this one is extremely practical. The reputation of this place is very good. The degree you're doing is very, very high standard. So I would have thought that to not have that honours, if you can do it, doesn't really make a lot of sense, because you really straight away stand out, and there'll be a lot of potential opportunities, not just now, but for the next 10 years. It's not just the graduate role. It's when you're going for that next role in your second or third year out of university, or the role after that when you're 28, 29. That honours degree still matters when they're culling candidates. So I think from that point of view it's pretty obvious. And then the other one's just expertise. My experience a long time ago, 25 odd years ago, and I did economics and finance as my majors, and that year of honours really takes you to another level of expertise and confidence around the subject matter. So I think from that point of view it's also really important to think about it. I mean, to summarise, and I think you've had a pretty good taste of it, the one message that I said before is you really have to think about why you wouldn't do it. The other one is that extra year is effectively, I think, doubling the impact of your degree. So an honours degree, to some extent, you could argue is worth twice as much as just a straight bachelor's. Anyway, I'll leave it there, and I'm happy to take
yeah, if you have any questions, we can have a quick answer. And there are various programs, there are scholarships, there are part-time programs. If you do have a job offer and there is a still possibility, you do it part-time with your support from your employer if they value your growth.
What's the process to get into the
Yeah, the webpage has a application form, and basically you fill in the application form and you attach your academic transcript, and the eligibility criteria is basically 170 in your finance subject, and that doesn't necessarily get you into the program, but means you are eligible to apply. No? Oh.
So, Warren, you did a finance honours. Why did you do a finance one over an economics one?
I did economics others. I did a finance and economics double. I actually really enjoyed uni, and so I was there for 5 years. And I'm really grateful because as soon as I left uni, I didn't stop working my backside off for 20 odd years. You know, it's good to enjoy this time and that extra year. No problem. But yeah, and I did economics honours. Yeah, you couldn't do a double in honours, obviously. But it's all when you get out there. I mean, unless you want to be an economist, the economic contents and intuition that lies behind this particular finance degree is very strong, and is certainly at the highest levels when you're talking about jobs in whether it's fund management or dealing rooms or investment banking or whatever.
All right.
Thank you. Thank you, everybody.
Thank you very much.
I'll send you the outline for this.
Yes. Let me just give you this one back.
Thanks a lot.
Thank you very much.
Yeah.
All right. See ya. Okay. I'm gonna make this. Hope you had a good time just now, and also finishing your first part of the assignments. We're gonna go straight into today's topic. So just a quick recap on what we've been doing these last few weeks. We started by doing a top-down approach, looking at the industry level. Then we did an analysis on how the historical financial statements of the company and what they say about how the company is doing. Last week, we worked on forecasting, and what we are doing this week is basically understanding cash flows. And the main reason for doing this is cash flows is what we use to value either a firm or the equity stake on a firm. So things we're going to be looking at today quite quickly. The first part, we're going to be looking at cash flows from a cash flow statement perspective, so more on an accounting side. And in the second part of today's lecture, we're going to be looking at calculating cash flows for valuation. So slightly different approaches to the same matter. I'm going to skip that. You'll have to forgive me. I didn't know we were going to have visitors today, so the lecture is planned for 1.5 hours. I will need to skip a few bits, but so basically the reason why we're doing cash flow analysis, or what we are trying to get from our cash flow analysis, is looking at how strong is the cash flow generation from the company. Is this a company that consistently generates strong cash flows, or are cash flows fluctuating year on year? So it's not only cash flow levels, but it's also how stable and sustainable they are that we are looking at. How does the company manage working capital? Working capital is the main item to lay eyes on, especially for growing companies, because working capital could be what makes a potentially successful company go bankrupt very quickly if you don't manage working capital properly. So we're also asking the question whether the company can meet the short-term obligations. Does the company have enough funds to finance growth? Is the company in a good position to pay dividends or not? And we're going to be doing this both looking at historical financial statements, but also looking forward in terms of doing forecasts and looking at how cash flows are likely to be in the future. We also look at what sort of external financing we're using and whether there's any free cash flow available. So in your tutorials today, you're going to be doing the forecasting, the practical part of forecasting, and you're going to be forecasting income statement and balance sheets. And then next week, or in our next tutorial, what we will do is with those forecast income statement and balance sheets, we're going to calculate our cash flows. So why are you using cash flows and not income statement earnings? Well, there's adjustments, accounting adjustments incorporated in earnings in the income statement that make them a suboptimal option to do valuations. For that reason, when we measure cash flows, when we calculate cash flows, we have to do two types of adjustments. We're going to be doing adjustments on expenses that are not cash expenses, and we also make adjustments based on investment needs at the balance sheet level. But I will come back to that in a few minutes. So the main reasons why sometimes income does not match cash flows is cash receipts, cash expenditures, and how you recognize revenue and expenses. I will come back to that shortly. When we do cash flow analysis, we're looking at the company's financial statements, and we basically look at all our income statement items and the variance in our balance sheet items. And from each of those, we can infer cash flows. And those cash flows can either be operating, investing, or financing cash flows. So one of the things you will do when you look at the company companies you're analyzing is you will first calculate those variances, understand what the cash flows are, understand whether the cash flows are positive or negative. And then the other thing you will do is you will align or categorize these cash flows as either operating, investing, or financing. As for the different types of cash flows we can work on, I'm going to skip this because that we will see in a few minutes. So what's the usual starting point when we do cash flow analysis accounting way? The starting point is the net income. The reason for that is net income is the bottom line in the income statement. So we already have all the revenues and expenses incorporated in that net income. The only thing we need to do in order to extract cash flows out of this net income is to make adjustments such as adding back non-cash expenses. There's a few expenses that are not actually cash expenses. Can someone tell me the most well-known case of a non-cash expense? Depreciation, yeah. So that is the number one adjustment we do to cash flows or to net income to adjust for a non-cash expense, right? So next week's tutorial will have two components as well. You will be working with Coca-Cola Amatil's annual statements, financial statements, and you will have to calculate the statement of cash flows and look at where money is coming from and where it's going to. I won't go adjustment by adjustment here. That is something we will do in the tutorial next week. And what I will do is give you the underlying assumptions while we are working with cash flows. When we look at the balance sheet side of the cash flows, we got, this is our balance sheet. Our assets should equal liabilities plus equity, and that is also true for the variance between one year and the other, right? The change in assets should equal the change in liabilities and equity. So whatever additional assets we need to fuel the growth in the company will have to be financed in some way. And if we're talking about a firm that is in decline, if the base of assets is going down, what that means is that the company will have to get rid of some of the sources of financing. Right? If you have a growing company, you would expect sources of external finance to be positive, to get new money from banks and equity holders. But if the company is shrinking, you would expect the company to either pay more dividends, repay debt, or buy back shares. And what we do when we create our cash flow statements is we extract just one of the assets, which is cash, because all the other accounts are playing against cash. So when you do your cash flow statement analysis, what you're basically doing is measuring the difference in each of the items, say accounts payable, accounts receivable, and so on and so forth. And for each of those, you will look at the variance, absolute, what was the change in that number. You will see whether that number is a positive or a negative cash flow, and then you will assign it to either an operating, financing, or investing category. And what the bottom line in this slide is telling us is that if we make the sum of all the variances in all the non-cash assets plus the variance in the liabilities and the equity, what we would have as a result is the change in cash between one year and the next. This is going to be very clear next week when we work in a spreadsheet doing this. So this is what we're doing next week. We're doing that for Coca-Cola Amatil in 2015. So how do we look at cash flows, having a little bit more context about the companies? What can we expect about companies' cash flow when we look at them? One of them is we know that cash flows are heavily influenced by the stage in the life cycle the company is. And by that I mean you have companies at very early stages, growing companies, mature companies, declining companies, right? And you would expect the sources of funds and the uses of funds to be completely different at different stages, right? So you would not expect a high growth firm to have the same cash flow profile as a mature company, right? So if you're looking at startups growth firms, maturity firms, and firms on decline, you would expect to have completely different profiles. You would expect that as you go down this list, investment needs decrease, you would expect investments or sources of external finance to peak in growth firms, and you would expect companies in decline to have excess cash that they would use to repay shareholders and debt holders. Let me show you, I will come back to that slide there. Let me show you a numerical example of how at those 4 stages you would expect cash flows to look like. So when we are talking about cash flows from operations here, we're looking at the day-to-day operations. So we're looking at working capital, basically, right? We're looking at how the company gets paid for what they sell and how do they pay what they buy from their suppliers. When we're looking at investing cash flows at this level, we are thinking about investing in property, plant, and equipment, and also investments outside of the firm. And finally, when we're looking at financing, we're looking at the relationship between the firm and shareholders and debt holders, which are the main providers of external capital. So let's have a look at a startup. If you're looking at a startup, you would expect the company to lose money doing what they do, because initially when you want to set up a business, you want to convince people to buy your product or services, so you will probably be selling with very small margins or even negative margins. So the operations of the firm initially will get negative cash flows. At the same time, the company is investing in infrastructure to make sure that it has enough capacity to drive additional demand. So we're having negative cash flows from operations and investing, and the only positive cash flows come from financing. At this stage, who do you think is going to be doing that investment? Would it be mostly debt holders or equity holders? Yes, equity holders. And what type of equity holders would they be?
The people that have started the company would probably contribute their own money, and then
Yeah.
they could go to like private.
Yeah, and what sort of private would be, what sort of shape of private would this be?
I'm not too sure.
It would initially be venture capitalists. Like you would have angel investors like family and friends, then venture capital investors, potentially private equity investors, and then the company will eventually become public if they decide to do so. But at this early stage, all of the money coming from financing will definitely be either founders, family and friends, angel investors, and venture capital investors. Those are the guys that are putting money because they believe in the management team, in the idea, and they're willing to risk some money in there. Growth stage is, we know many firms don't go past this stage, right? Many firms, many startups fail to make it to the next level. They don't succeed, they don't get a market for themselves, either because they cannot create the new market they were supposed to create or because they couldn't tap in an existing market. So companies making it to the growth stage will typically start having positive cash flows, because once the demand is there, the company can increase their margins. So each transaction, instead of being money-losing transaction, becomes a money-making transaction because they have a larger margin. They can put prices up. So companies at this stage will typically have positive cash flows from operations. They would still need financing because that growth stage will definitely need the company to increase capacity. In order to increase capacity, those are the big dollars you have to invest in property, plant, and equipment for the years to come. So at this stage, the company is making big investments, large investments, that will last for the next 20, 25 years, but they need to get financing for that. And financing here will mostly come from equity as well, but you would start to see some debt financing coming on board. Or you will have some hybrid instruments. You will have debt instruments that, given some circumstances, will turn into equity. Warrants, for instance. So when we're looking at mature companies, the kind of profiles you can expect is the company to continue to have positive cash flows from operations. A mature company will have much lower needs for investment, right? And remember, at this level, we are looking at investments as CapEx, as property, plant, and equipment, mainly. So a mature company, what would be the relationship between CapEx and depreciation? You would expect, that's interesting. All right. Let me just get there. Oops. Go back. So you would expect, what was I saying? Does someone remember what I was saying? Yeah. CapEx and yeah. So what would you say is the relationship between CapEx and depreciation at the startup level and growth levels? Which one would be higher?
You're in the way of your own plan.
Yeah, the startup and growth levels.
The relationship.
Between CapEx and depreciation. Which one would be larger, depreciation or CapEx? CapEx would be much, much larger than depreciation at the early stages, right? Because you're investing a whole lot initially, and depreciation is only lagging behind. When you get to, well done, and thank you. When you reach maturity, you would expect the company to only be investing in CapEx enough to maintain capacity, right? So at that level, you would expect depreciation and CapEx to be quite leveled, right? So the company has no need to continue to grow. The only investments the company are making are to just keep up with capacity. And when you move to the declining stage, you would expect the relationship to flip and to start having lower CapEx than depreciation, because the company does not need as much capacity as in the past. So those are underlying factors that have an impact on how the cash flow profiles change. And one more thing about declining companies is that you would expect these companies to start having negative financing cash flows. Can someone tell me what that means, or what would explain that? What does negative cash flow from financing mean? Yeah, that means we're paying back, right? So that means we're not only paying back interests, which we've been doing all along, but it's probably that you're also paying back principal to debt holders, or that you're buying back shares, or that you are paying more and more dividends, right? So that is the typical profile at those 4 levels. So I'm just moving back to slides 12 and 13. They basically describe the things we've been discussing in the table on slide 14. I just wanted to highlight the idea of multi-product firms. This is something that you can see very clearly in Coca-Cola Amatil when you look at it. Coca-Cola Amatil is largely a mature company. When you look at the growth profile, they're growing at 3% per annum, right? But then when you look at the different business units, what happens with them is that more than 80% of the business is soft drinks, right? And that's a very mature market that is not growing too much. But at the same time, they're definitely a multi-product firm, and they've invested in alcohol and coffee businesses, and those businesses are higher growth than the soft drinks for them. So they're definitely battling in new markets, and you could expect some growth from them. And the other thing that they have as a company is that they not only operate in Australia and New Zealand, but they also operate in Indonesia, in Fiji, and they have other markets with much higher growth potential. So what you need to think when you're looking at a company and its cash flows, in lights of these potential profiles, is that if the company has multiple business units at different stages of the life cycle, cash flows could be a combination of the ones we've seen, right? Because you will have Coca-Cola Amatil has 80% of their business here, but they would have 15 to 20% of their business here. So when you look at a business level, business unit level, cash flow profiles could be slightly different. We've mentioned working capital, or I've mentioned working capital a few times already in previous weeks and today. The most direct reference to working capital in what we've been doing before is when we looked at ratios, and we were looking at ratios of turnover, and we were looking at turnover at the accounts payable, accounts receivable, inventory, and cash levels. All those components make up for what we call working capital. And working capital will be the difference between your operating current assets and the operating current liabilities, right? So what sort of things do we exclude from working capital calculations? We exclude anything on the asset side that is not used for operations. So for instance, if you have excess cash, or if you have short-term investments, a short-term investment would be a deposit made by the company at a bank, or buying bonds, or buying some sort of financial instruments to make interest out of those. Those items we would exclude from our calculations for working capital. What would we exclude on the liability side? What we will exclude from the liability side is any liabilities that are not related directly to operations. And the main type is short-term debt. Right? Short-term debt is something that we will leave aside when we do our working capital calculations. Why is that? Because financing working capital comes down to a decision that is not an operating decision, it's a financing decision. Once we have a good understanding of our working capital and see whether we have a long cycle or a short cycle. A short cycle being one in which pretty much by the time I have to go and pay my suppliers, I've been paid by my buyers. So I'm pretty much buying something, selling it, taking the money from my buyers with a margin, and using part of that money to pay back to my suppliers. That's perfect world. We don't need to get any financing in our short-term operations. The most likely case is that you're going to have a long cycle or longish cycle in which by the time you have to go back to pay your suppliers, your buyers still haven't paid you because you're giving them more credit, right? So what happens in that case is at the operational level, and in order to succeed in the market, you have an operating strategy and you need money to finance that strategy. And the next level of decision on the financing side is whether you finance that with short-term debt, with long-term debt, with equity, or with what sort of short-term debt. Usually, you would like to finance working capital with short-term liabilities, because you wouldn't want to have long-term liabilities financing a short-term asset. But then the type of liability will be different. Wow. I was not expecting that. So I just mentioned one way to look at this is via turnover, but when we looked at the turnover ratios, we saw that any turnover, as for instance, my inventory turns 4 times during the year, right? We can see that turnover as number of days, because you know that if your inventory turns 4 times in the year, that means that on average, how long does it take you to sell all your inventory? 90-something days, right? Because if it turns 4 times in the year, that means that the number of days it takes you to sell your inventory is 365 divided by 4. So visually, definitely looking at working capital from a days in payables, inventory, and receivables is the best visual picture to understand whether you need financing or you have a positive working capital. The main thing, and this is thinking about your final exam, when you're looking at working capital, you're basically getting assets minus liabilities, and you're calculating the difference in between 2 different years, right? So the main trick when you're looking at working capital is this a positive cash flow or negative cash flow? Always when you think about working capital, think about it as an asset, right? So if you have an increase in a non-cash asset, is that a positive or a negative cash flow? You have an increase in a non-cash asset, such as working capital. Is that positive or negative cash flow? Did anyone say? Let me give you an easier example. Let's think about property, plant, and equipment. You bought a new building, right? That's an increase in assets, okay? Is that a positive or a negative cash flow? Negative cash flow, right? Asset comes in, money goes out, right? So same thing for working capital. When you have an increase in working capital, you treat it as an asset. It's a negative cash flow, right? That means we are having a cash outflow to finance our day-to-day operations. a positive cash flow will have to come from somewhere else, and that will be the financing side of it, to bridge that gap. So what are the main risks with working capital? Working capital is pretty tricky when you're in inflationary contexts, when there's a lot of inflation, which is not the case right now. When you have variable demand, because if you have very variable demand, you're going to be on the low side of the cycle, you're going to be paying for purchases you did on the high side of the cycle. So the needs for financing when you go from a boom to a burst are going to be quite large. And it's going to be the opposite when you go the other way around. When you're going on the boom side of the cycle, you're still paying your payables from the low side, which are going to be much less than what you're selling on the top of the cycle. So shifts in the economy definitely have an impact as a risk in working capital management. Other things that you have to understand is how we finance working capital. Having in mind the idea that financing tends to be sticky. So if you get financing specifically for working capital, and then you have a variable demand, there's the risk that you would still have the level of financing for the top side of the cycle, and you would be paying interests on money you don't actually need. So it's not uncommon to use line credits for working capital, where you have a minimum that you're paying on a normal basis, and you only get additional financing as needed throughout the cycle. So if you're going on the peak of the cycle, you get additional financing, but then the contract with the bank goes back to that minimum that you want to have as base financing. Other things that you have to consider when you're looking at working capital is whether the company is pursuing an optimal capital structure and how the variability of working capital has an impact on that. So definitely two key concepts here with working capital: how to calculate it, how that creates a positive or negative cash flow, and the second side is how you finance it. How do we define good cash flow? It should be enough to pay your bills, but in the end you will make an industry analysis and compare the firm to its peers and see how the company actually does against the peers. I will skip Jensen's free cash flow study. This basically says, I'm going to give you a very short spiel. So in 1986, Jensen did an empirical work and saw that there was a lot of cash being used by firms buying firms in unrelated industries. And what he found out is the more money is in the hands of managers, the more likely they will be to try and do empire building, right? Like trying to get as many assets under their hood as they could. So one of the outcomes of his agency theory of free cash flows is that there's an additional incentive for firms to have debt, because when a firm has debt, the threshold managers have to get over is higher, because they have interest payments to make, and that will help keeping them in their toes and managing the company's money in the best interest of shareholders. From now on, this is the best part of today. This is what you have to take home. Not that the other part is not important. This is definitely what you're going to be using in part B of your assignment. When we're looking at cash flows for valuations, we have two clear levels of cash flows. One is what we call the free cash flow to the firm. So what we're doing there is we're measuring how many dollars is the company generating after paying all the operating expenses. So the top side there, free cash flow to the firm, we're looking at operations. We're assuming, or we're looking at the firm as if it had no debt, right? And the reason for this is we just want to see how the operations of this firm are doing. This is a look that is very interesting for funds trying to buy companies, where you go, I don't really care how efficient or inefficient is the way this company is financing their activities. I just want to see whether there's potential at the operating level. Because if there's opportunities at the operating level, we can buy this firm, finance it ourselves in the best possible way, so we can disregard how the financing side of things goes. So this is the cash flow that is left available for debt and equity holders. The other level is free cash flow to equity. Very similar acronyms, FCFF and FCFE. So this is the cash flow available for equity stakeholders. So that is the cash flow that the company makes available to equity holders after paying all operating expenses and all expenses related to the relationship with debt holders, right? So you would expect, so this is money left for both debt holders and equity holders. This is money left only for shareholders or equity holders. These two cash flows we can use to value a firm or the equity stake in a firm. How do we calculate them? Two ways to start this. We're definitely going to start from the income statement, but we can either start from net income, as we did in the more accounting view of cash flows, or we can start from EBIT. So as you would imagine at this point, net income is already earnings to shareholders, so it will be a good starting point to calculate free cash flow to equity. Whereas EBIT, that is an operating earnings or operating profit, will be better suited to calculate free cash flow to the firm. Let's see how we get from net income to free cash flows to equity. We have to make a few adjustments. The first one is the one that we mentioned previously, which is adjusting for depreciation and amortization, basically because these are non-cash expenses that, just think while we're doing this net income is the bottom line of the income statement. So depreciation has been deducted already. We want to deduct it at the income statement level because that lowers the amount of taxes the company has to pay. However, when we want to look at actual cash flows, we know that this money didn't come out of the firm's pocket. So we just add it back. Two adjustments on the left-hand side of the balance sheet. One is the change in net working capital, which we will see in a minute, but we mentioned already. So in there we are considering accounts receivable, payable, inventory, and operating cash. The other operating investment is CapEx, which is the investment in property, plant, and equipment. And finally, we need to adjust for changes in principal, in debt's principal. So that is the relationship between the firm and debt holders. And this could be from last year to this year, we had an increase in debt or a decrease in debt. If there's an increase in debt, is that a positive or a negative cash flow? Last year we had $1 million in debt. This year we have 120 mil in debt. Is that a positive or a negative cash flow? Positive, right? Because the increase in debt, that means that banks lend us 20 mil that came in the pockets of the company, right? So that's how we get from net income to free cash flow to equity. I'm going to show you an example in a minute. Let's have a look at how we get from EBIT to free cash flow to the firm. So we're basically looking at depreciation and amortization, adding it back, minus operating taxes. What are operating taxes? Operating taxes are, remember I told you, free cash flow to the firm is the cash flow the company would have if they had zero debt, right? So that is operating cash flow, operating taxes. Operating taxes is saying what amount of taxes would this company pay if they had no debt, right? So instead of deducing or deducting interest payments before calculating taxes, we calculate taxes before interests, okay? Then we also adjust for net working capital and CapEx. And that's how we get to the free cash flow to the firm. And what we have in between these two blue rows here is the sort of adjustments we have to make to go from free cash flow to the firm to free cash flow to equity. And that is basically looking at all the non-operating incomes and expenses that could be coming from debt, and that is interest expenses. It could be coming from external investments, that is interest income. And it could be other income coming from participations in other companies. And finally, the last two items that we have to adjust for is non-operating taxes. So those are the taxes on these two guys up here. And finally, the change in short and long-term debt. So let's try and go for an epic achievement, which is calculate free cash flow to the firm and to equity for this firm in the next 10 minutes. Very quickly, for this company we have income statement, 2 consecutive years. We will mostly use 2019. Say this is the forecast for 2019. And we have the balance sheet for 2018 and 2019. Where would cash flows come from? Cash flows would come from this year of income statement, and they will come from the difference in between last year and this year at the balance sheet level, right? Let's have a look. So what we have here is how we get from EBIT all the way to free cash flow to the firm and free cash flow to equity. Let me go line by line. If we look at, I'm going to be switching back and forth between slide 27 and 26. 26 is our income statement and balance sheet. We just need to find where these 23.8 come from, right? So if we go back to the income statement, we have an EBIT of 126.2. And how did we get from to here? We sold this much, cost of goods sold, selling and general expenses minus depreciation. So the first thing we're doing is we're getting those 126.2 and we are adding back the 23.8 in depreciation. That is what we're doing there, okay? So next adjustment. we need to adjust for net working capital. How do we define net working capital? Net working capital is the difference between the operating current assets and the operating current liabilities. I just got here 3 items that I considered as operating asset, and operating liability. Just keep these 3 in your retinas, and I'll go back to the balance sheet. So we're basically using operating cash, tick. We're using inventory. We are not using excess cash, because that is cash that is not needed for operations. And in the current liabilities, we have 2 items. Accounts payable, we're including those, but we are excluding short-term debt. Right? Short-term debt is not operations. So that's what explains why we're using this, and that. So what we do for both years 2018 and 2019 is we calculate the net working capital. Net working capital in 2018 is 30. This 30 is 5 plus 45, 50, minus 20 in accounts payable. I'm doing the current assets minus the current liabilities. Okay? So we got a net working capital of 30 last year and 36 this year. That is an increase in net working capital. And as we said before, net working capital, we treat it as an asset. Any increase in a non-cash asset is a cash outflow. Hence, the minus 6 here. Right? So what we're doing is 30 minus 36 minus 6, that is my investment in net working capital. Next line, CapEx. We only need net property, plant and equipment, which is 250 last year and 300 projected or forecasted for this year. So there's a $50 increase in net property, plant and equipment. However, we know there's 2 things having an impact on net property, plant and equipment. One is CapEx, bringing net property, plant and equipment up, and the other one is depreciation that brings it down. Right? So what we're doing here is we can infer what CapEx was by knowing net property, plant and equipment this year minus last year plus depreciation this year. So let me go back to the income statement and balance sheet and show you what we're using. We're using this year net property, plant and equipment, last year's property, plant and equipment, and this year's depreciation. Right? We did the same thing in the forecasting lecture last week. So what that means is between last year and this year, the company went from 250, invested 73 additional million in CapEx, but they had a depreciation of 23 point something, so the net increase of property, plant and equipment was only 50 mil. Finally, we need to calculate operating taxes. I would write here in between brackets, this is taxes on EBIT, right? So those are the taxes we calculate on EBIT. If you look at this company, the tax rate is 30%. If you do 30% of EBIT, so 30% of 126.2, you're going to have the minus 37.86. Or thereabouts. Yep.
Just back on the CapEx, is there a reason why that positive 73 was recorded as a negative? Is that because of the non-increase in...
What what we know is CapEx. CapEx is buying assets, right? It's an increase in assets. Any increase in assets has a cash outflow, yeah. But that's a very good point, because what you will have, this is clearly a growing company. What you would have in a company that is in decline is having depreciation that exceeds CapEx, right? And you would have at some point companies that are selling their assets, and in those cases this could even be positive cash flow, because if you're selling assets, you're getting money in return. Yep.
Is there any reason why you add depreciation in the first line item and then remove it subsequently in the CapEx line item?
So the reason why we add it back here is because it's a non-cash expense.
And then you immediately remove it in CapEx?
No, and then it's a separate thing now. When we have limited information here because we only have the net property, plant, and equipment. So we have to infer what the CapEx was. And we know that CapEx goes up with, that property, plant, and equipment goes up with CapEx and down with depreciation. So we have to do the math to calculate it. If you were looking at the financial statements of this company, you would have the value of gross property, plant, and equipment. The difference between one year and the next will give you CapEx without having to do this calculation. So the reason why we're doing that here is because I wanted to fit everything in a slide, so the balance sheet was missing some things. But the only reason it's not that we're doing it twice for any reason. We're just using depreciations to infer the level of CapEx. So if we get our EBIT, add back depreciation, and adjust for net working capital, CapEx, and operating taxes, we get our free cash flow to the firm. We will see next week how do we use this cash flow to value a firm. Next up, we can continue, and if you look at these three lines here, interest expense, interest income, and non-operating income, I will go back to the income statement and show you that those three lines are these three lines here, right? Those are the non-operating income and expenses, right? We want to treat those separately from the operational side of things. So what we are doing is, in order to, even though those items are not operating, these are items that make or lose money for shareholders. So we have to show them in the cash flow to shareholders. That is what we're doing here. And the next thing we're doing is we're looking at the tax implications for those three guys, right? So this 1.9 here, if you add these three guys up, right? If you do minus 14.63 plus 3 plus 5.3, multiply that times 0.3, that is the amount of tax credit, in this case, that you would have from those non-operating items. And the final thing we need to do is to see whether we already saw how much we were paying in interest to banks, but we didn't reflect how much money, additional money we got from banks in principle, or we returned in principle. And that is what we're doing at this very level. So let's see where this 5 is coming from. We go back to the balance sheet. We have debt at two levels. Short term, it decreased by 13, from 113 to 100. And long-term debt went up by 18, from 80 to 98, right? So in balance, the company dropped 13 of short-term, increased long-term in 18, so the net change is an increase of 5, right? More debt coming in the firm. And that is exactly what we're showing there. And this, if we add all those things, we get to the free cash flow to equity. Yes?
Sorry, can you go back? How did you get the 190 for non-operating taxes?
It's adding up these 3 times 0.3, which is the 30% tax rate. This is negative, and these are positive. While you check that, so 2 more things to adjust. One is looking at dividends. If we look at the income statement, this company is paying 16.78 in dividends. And if you do 32.9 minus 16.78, you get what is usually called the net cash flow. And if we've done this correctly, look at what we've done throughout this. Just bear with me a sec. We got EBIT, we got operating taxes and non-operating taxes. If you add these 2, you're going to get the taxes in the income statement. And we got the 3 lines of non-operating interest, expenses, and income, right? EBIT, taxes, and the other income and expenses. Let's go back to the income statement. EBIT, the 3 sources of other income and expenses, income taxes that we have in 2 parts, operating and non-operating. So we covered everything in the income statement. If we move to the balance sheet, we calculated the change in net working capital. By doing that, we looked at this line, we looked at this line, and we looked at this line. Then we calculated CapEx. When we calculated CapEx, we looked at this guy. The other thing we did is we calculated the change in short and long-term debt, taking into account this line here and this line here. And then we looked at dividends paid, which has an impact here in retained earnings, because we know that these retained earnings are whatever the income was minus the dividends paid. So if you think about it, in getting from EBIT to the net cash flow, what we did is we took into account all the items in the income statement and all the items in the balance sheet except for one. What is the one that we didn't touch? The one we didn't touch is excess cash, right? Because we're looking at the changes of everything against cash. So if we've done this correctly, our net cash flow at the end of 2019 should equal the difference in net cash. So let's go to the bottom here and see our net cash flow is 16.13, which is the increase in excess cash we had between 2018 and 2019. So that is your check to make sure you got everything in line, that you've included all the items you needed to adjust for, both in the income statement and the balance sheet. So this is the long thing. We have a way to get to the free cash flow to equity from net income. I'll leave that to you because we are doing the same adjustments, only that we need to do fewer adjustments because net income has more information in it than EBIT. And we almost did it. I'm 4 minutes late. Happy to come back to this definitely in the tutorials. We're going to be doing this in Excel next week. So that's going to be a really good point to like finalize this.